In 1928, $100 was roughly a month of work for a typical American household. It is a small, ordinary amount of money, and it is the only thing this episode is about. That $100 was placed into 7 different things and then left completely alone for 97 years. No trading, no timing, no adjustments. What comes back is not a lesson about which one was best. It is a lesson about what a chart is capable of concealing. Because one of the 7 lines on this chart spends 40 years telling a lie. The numbers come from a dataset maintained by Aswath Damodaran at NYU Stern, updated in January 2026, with the underlying Treasury data drawn from the Federal Reserve database in St. Louis. It is public. It is free, and anyone watching can download it and check every figure spoken here. One detail about the chart matters before anything moves. The vertical axis is not evenly spaced. Each step upward is 10 times the step below it. This is not decoration. On an evenly spaced axis, one of these lines would climb so far above the rest that 6 of the 7 would be flattened into a single indistinguishable smear along the bottom. The bent axis is an admission that the honest picture does not fit on a screen. The chart opens with a fall. $100 in the S&P 500 grew to about $144 in 1928, and then the floor gave way. By the end of 1932, that position was worth about $50.66. Half the money gone in the first 4 years of a 97-year hold. 1931 alone took nearly 44%. Meanwhile, the Treasury bond line sat at $116, calm and slightly higher than where it began. Anyone comparing those two positions in 1932 would have reached an obvious conclusion, and the obvious conclusion would have been wrong for the next 9 decades. Now, the strangest feature of the entire chart: follow the gold line through the 1940s. It does not move. Not approximately. Exactly. In 1941, it sits at $164. In 1942, $164. 1943, 1944, 1945, 1946, 1947, 1948. The same number year after year, a return of exactly 0.00%. Markets do not produce numbers like that. Governments do. On April 5, 1933, Executive Order 6102 made it illegal for private citizens in the United States to hold gold coin, bullion, or gold certificates beyond a small exemption. Holders were required to deliver it to the Federal Reserve at $20.67 an ounce. The following January, the Gold Reserve Act fixed the official price at $35 an ounce, where it was held by law rather than by markets. Private ownership was not restored until legislation signed by President Ford took effect on the 31st of December, 1974. 41 years. So that flat line is not a picture of a boring asset. It is a picture of a price that was not permitted to change, held by an asset most Americans were not permitted to own. The chart plots it as an investment. For most of that stretch, it was not available as one. Once the price was released, the line stops behaving like a line and starts behaving like a fault. 1972 up almost 49%, 1973 up nearly 73%, 1979 up more than 126% in a single year, and then long punishments, down 32% in 1981, down 19% in 1984, down 27% in 2013. The most recent year in the dataset is its own kind of outlier. In 2025, gold returned just over 66%, taking the position from about $12,600 to roughly $21,000. Here's the comparison that tends to surprise people most, and it has nothing to do with gold. $100 tracking residential real estate over the same 97 years finished at about $5,626. $100 in 10-year Treasury bonds finished at about $7,753. Housing over the full period finished below government bonds. That result deserves an immediate qualification because, without it, the comparison is misleading. This series tracks property prices only. It does not include rental income, and it does not include leverage, which is how most property is actually owned. Both of those change the arithmetic substantially. What the line shows is narrower than what people usually mean when they talk about housing. At the end of $1925, placed at the start of 1928, 3-month Treasury bills reached about $2,578, 10-year Treasuries $7,753, corporate bonds rated BA about $53,952. The S&P 500 with dividends reinvested reached $1,157,599. And the line above it, which almost never appears in videos like this one, is the smallest tenth of the American stock market. That position finished at approximately $6,460,000 $62,000. More than 5 times the S&P 500 from the same $100 over the same years. 3 things are wrong with this chart, and they should be said plainly. The first is survivorship. This is the record of a market that continued. Several national markets over the same period were suspended, closed, or erased, and their charts are not the ones that get drawn. The second is that the investor does not exist. These lines assume someone who never sold, never added, never withdrew, and never needed the money during the 4 years it fell by half. That is a mathematical device, not a person. The third is friction. Taxes, fees, and spreads appear nowhere on this chart, and each one removes a small amount every year from precisely the quantity that compounding depends on. The smallest decile line in particular would have been extremely expensive to hold for most of the last century. The useful part of a 97-year chart is not the ranking at the end. It is the number of years each line spent looking like a mistake, and the number of years a line was not showing a market at all. A flat line usually reads as safety. On this chart, 40 years of flatness was a law, and no one holding that line at the time had any way to see, from the shape of it, which of the two it was. The data is a record of what happened once. It is not a schedule.